Thank you, Karen, ever so much for coming and sharing a little bit of your knowledge and time with us. It's really, really kind of you because I do know you're a very, very busy individual and extremely engaged with the people who you help with investments. So, first of all, thank you very much.
No,
So,
thank you for asking me to come along, Baron. Much appreciated.
absolute pleasure. So, Karen, please can you tell us a little bit about your massive wealth of experience, uh, qualifications, and your phenomenal knowledge?
Oh my goodness, that's a bit of an opening statement, an opening gambit. Um, so I have been in this industry for, gosh, 30 years, just over 30 years now. So a very, very, very long time. Without, I guess, going verbatim, I suppose, in terms of everything that I've done. But I started off as a tied advisor through a bank, Royal Scottish Assurance, who are part of the Royal Bank of Scotland. And I have to say, a really good grounding. One of the things that they were really keen on, I think before they were ahead of the time, actually, before a lot of other companies were, we had to be qualified at that point, and that kind of set the scene for me. I was always taking exams, so I have got quite a lot of financial services exams, which is, I guess, you might expect, but to the point where I am a fellow of the Chartered Institute. So I did all the relevant exams to enable me to get to that level, which I feel very proud of. And I am still looking to take more exams just because I'm a bit of an exam junkie. So there we go. Um, I, after being with the Royal Bank of Scotland, I went to become an independent advisor. And then, after having children around them, I decided to set up my own little practice, which was 15 years ago. And that's where we are today.
Oh, excellent. Brilliant. Okie dokie. So you're well set then to kind of give us the advice of where we can go and wealth management, to say the least. In fact, you're probably overqualified. It
Well,
sounds like.
hopefully. I mean, as I say, I've got a lot of experience in it, seen a lot of things, been through, I suppose, various challenging economic times,
Good.
uh, various times when the stock market has had the bottom fall out of it. So you learn quite a lot in those in those times, shall we say?
No, to be honest, that's a very good point because when you think about COVID and how many
Mhm.
market crashes we've had, and then particularly even in construction, I can remember at least two in
Yeah,
my lifetime that affected me as well. So
yeah.
for you guys to continue to advise people through that period and be successful is a very,
Yes.
very impressive track record, to be honest. You're just not a newbie on the block chancing your arm. You've got a proven track record, which is excellent.
Yeah.
So,
Yeah.
okay then. So, what are some of the common misconceptions about wealth building that you've often come across?
That do you know what? That's a really difficult question. I was thinking about that. Um, and I suppose um the big things are about being an overnight success. I mean, you've got a lot of people who um, will follow trends and tell you that you need to be investing in this, that, and the other, that you can lose all your money and in different scenarios if you don't go down various routes. So I suppose I guess the thing that I would say is that a balanced approach with everything, including all forms of different asset classes, that is the best way to manage your money. So um yeah, so overnight success, if you invest in this, you can become millionaires. You're not going to become millionaires if you invest in one particular type of stock. Um and it takes time. So I guess that's the I don't know if that really answers the question, but I
Oh,
think
it does, yeah, yeah, it does.
I
I
think
like, I like
that's
the point about there's no such thing as overnight success. You know,
yeah,
wealth is a long-term building process and
it
compound.
is.
Yeah,
Yeah.
yeah, it's very good. So if for somebody who's new to wealth building, what are some of the first steps really they should take, do you think?
So I think that's the key. I mean, I know building on what I was just saying before in terms of misconceptions or whatever. Actually, another misconception is about the cost of a financial advisor. Sorry, I'm backtracking
Oh,
slightly
it's fine.
in terms of that. I guess because I've been in the industry a very, very long time, obviously 30 years. And um, back in the day when I first started, the whole fee structure and different things like that was different as well. So sometimes I talk to people and they are shocked at how much it might cost to take advice. But hopefully, in terms of how we work and how we help different people, we can show that our cost is worth the um, for the benefits that they receive from that. Sorry, I know backtracking. But then coming back to the question there, for somebody new to wealth building, I think you need to look at the time frame. So time frame is a key. Again, going back and picking up on that, it's not about overnight success. It's a marathon, not a sprint. Are those the kind of terminology that we would look at? One of the things I try and say, certainly to younger people, and I think this is a key. And I wish I'd said this to myself, by the way, when I was 20 or whatever. With regard to the money that you've got coming in, always live 20% below that means. Never think you earn the 100%. You earn 80% of that. That 20%, put that away and never touch it. So never, ever, ever think that 20% is in your grasp, for whether it be for holidays, for house purchase, for anything. That needs to be put aside for your wealth for the future. And it might not need to be 20%, but a percentage of your salary each and every month, year, whatever. And I can tell you what, if you do that, you'll never be financially insecure, is what I would say. But it is looking at the time frame. Most of the things that I look at, and property kind of just fall into that as well. And I know you're the property expert here, Byron, and I refer people to you from that side of things. But you need to understand that actually, when you're building wealth, as I say, it won't happen overnight. So there is a time frame that you've got to look at. And most of the things that I would look at, you need to have a time frame of at least 5 years, to take into account the fact that markets will go up and markets will go down. Um, so that's one thing. The other thing that you need to be concerned about is your risk appetite, and the other thing is your capacity for loss. So, you know, and again, your risk appetite. So that's how much you can, I guess, stomach to a degree. That might be a bit of a strong word. The fact that your investments will go up and they will go down. And it's being able to accept that and being able to stomach the fact that, sometimes you might look at your investments and actually there might be less in there than you actually invested in the first place, especially in the earlier years. And you've got to be able to accept that. But the other key is capacity for loss, because it's fine being able to accept that, but also if the worst happened, what effect would that have on your standard of living? So those are the key. I'd say they're the key things to think about when you're first starting. So, you know, how long, what's your risk appetite, what's your capacity for loss, and I guess affordability as well.
That's very good, very good. Particularly about the 20%. There's a book called The Secrets of a Millionaire Mind by T. Harv Hacker. Very
Mm,
well-selling book, especially in the US.
yeah,
He says exactly the same thing as you, Karen, that
yeah,
you've got to think that the tax man's going to take 20% off here. So
yeah,
why on earth aren't you going to save 20% for yourself?
yeah,
So it's a very, very good point. And
yeah,
particularly about stocks. I mean, and shares. I mean, I invested in a company that when it was after COVID that hit rock bottom,
Yeah.
does come up. It has come up very well, but there's days when it doesn't do well at all, and it all depends on the contracts they've won and the way that they're running the business. So, and that changes from day to day, doesn't it? So
It absolutely, absolutely does. Yes.
you have
Yeah.
got to be able to understand that if you're going to go into, wealth
Yeah.
management on that side. That's brilliant.
Yeah. I was going to say, I think the other thing, so I might be jumping the gun here in
No,
terms
it's
of
fine.
jumping on some of the other questions that you may ask me, but you know, I think one of the key considerations as well when we're looking at investment strategies and building wealth is understanding the different asset classes that are available.
Mm,
So that includes obviously you've got I always say there are five main asset classes when I'm trying to sort of talk to a client and talk about risk and reward, etc., etc. But you've got cash being one, you've got government gilts being another, which I guess are a way the government raise finance. They kind of offer a guaranteed rate of return if they're held to redemption. You know the interest rate that you're going to get from them, but the value of those gilts can go up and down, so because they can be traded on the market and what have you. Um, you've then got property, and you've got stocks and shares, and then you've got things like commodities, coffee, gold, tin, and probably an alternative investments. And actually, if I consider the risk of each one of those, it's almost the risk. And when I say risk, I'm talking about the volatility, I suppose, and potential at times loss that it goes up. So cash traditionally, as long as the bank that the money's in will always be there if you don't spend it. However, the interest on that cash, if you're banking on that, inflation will be more than that. So the real
well,
value, the buying power of that is going to go down. Gilts are usually and bonds, which are loans to companies and where they pay a guaranteed rate of return, but they can produce a nice steady income into a fund. So again, they're other than we've had a little bit of a hiccup recently, of course, especially following the wonderful budgets that we've been given, where the values have sort of plummeted. But um, you've then got stocks and shares and property, and I put those on an equal keel, even keel, really, in terms of the potential growth that you can get on those. But also, there are times when property prices go down, and there are times where stocks and shares obviously go up and down. So, the time frame that you need to be planning on with those, I think, is a longer term. And then, as I say, you commodities, coffee tin, you can make lots of money in these kind of things, but they are far more volatile. My point where I'm coming to is that in order to build wealth, you need to consider all of those, I think, and all of those play a part in building your wealth strategy. You can't just put everything into cash and think, right, well, I don't want to take any risk with other things, because actually cash in itself, there's a risk putting it all in cash because of the real buying power of that money. So the only way you're going to make your wealth grow
mm.
is by looking at those other asset classes. Uh, um, so you need to have an element of risk in your portfolio in order to make money. And that's where you need experts like myself and yourself in order to help people do that.
That's very good, Karen. I must admit,
No.
you have covered quite a bit of what we wanted to talk about, but if I can just go a little bit
Sorry.
off piste for a moment,
Yeah, sorry.
you raised a point that I think would be very, very interesting, particularly for our younger people. So, when you first started, there was no such things as going on your phone and getting an app,
No, no, I know.
which there is now. So,
Mm.
my question to you is: these kind of like trading 212 and these kind of apps, are they, in your consideration, are they any use to people, or do you
Mm.
think that they're what they are? They're just getting people to put money in on an unknown risk because they're not getting advice from people like yourself. What's your opinion on these apps?
I think that Google, AI, all of that, all the amount of tools that you can get to guide you in terms of investing is good on the one hand, but can be quite dangerous on the other. I go back to the start in terms of um, people, the misconceptions. You can make loads of money overnight. Invest in this, invest in that, and you'll become a millionaire. Um, and I think that's a worry, because there are lots of ways in which you can lose money. So, I think crypto is a trend. And don't get me wrong, I've got some crypto, so I'm not knocking that kind of thing. But if you put all of your money into something like that, then it's your capacity for loss. It comes back to your capacity for loss and your expectations. I think it's always important to take guidance, if I'm honest. I think talking to somebody that has expertise and can, guide you to the right tools to invest. I mean, you know, I guess for myself, clearly, I mean, I do deal with people with liquidity of 250,000 plus, but I do deal with people, or I'm happy to deal with people of lower than that. I think quite often I'll have conversations with people, and then I'll guide them to the right tools that they need to go to in order to be able to do the investing that they want to do in a safe environment, I suppose.
Okay, okay. So do you know here we are today?
Hmm.
We're in the beginning of February in 2025.
Yeah.
Is there any hot commodities at the moment that are doing really, really well? Say, for instance, gold, or is there things that are quite flying at the moment that you think it's good, but I don't know how long that's going to actually will last for, or be sustainable, shall we say? Or
Oh.
really good old ones that we should always come round in the end, like property, usually on a 10-year cycle. It
Yeah, that
usually goes
I mean,
under its way, so.
I guess what I'm going to do is to other than property, I'm not going to mention any individual commodity or stock or whatever. I'm going to talk about them generally,
Okay.
um, just because I don't want to be seen to be
Karen Sheldon
I guess
said,
biased in. Yeah, yeah, yeah. I don't want to seem to be kind of guiding people to different places. I come back to it's a balance. So, I invest directly myself in individual stocks and shares. I look at the trends that are going on. There are your, I guess I try and yes, look at the trends. So, you've got you've got AI companies that I am investing in. You've got your good old pharmaceutical companies. You've got your good old um what's the word aerospace companies. So people might gather the kind of stocks that I invest in individually, because I think if you're looking at that, AI is always going to be here now. So if you're looking at those decent companies with that, um if you're looking at pharmaceuticals, there's always research and development, et cetera, et cetera. Things like gold, again, gold, I think will always be a fail-safe. You might go through periods of time where gold might go down a little bit, and I've seen that in the past. But it's a commodity that I guess is always going to be dealable, isn't it? So I think it's a spread of assets, but property as well. Property forms a part of portfolios. I mean, we've talked about this. I've got some properties myself, which I rent out. I'm not an expert in this in the way that you are, but you know, I talk to people again about about building wealth, looking to the future. It's about income streams. It's about spreading the risk that you've got. So I don't think you should be putting all your eggs in any one asset class. But then if I look at somebody like myself, I know that I've got some rental properties that I'm going to get some rental income from. So that's a cash flow that's coming in all the time. I've got some pensions, of course. I've got pensions. You would expect me to have pensions, and I've got some other investments. So it's a spread. I'm looking at all of that, and property does form a very big part of that. And I'm talking to clients more and more about I guess properties as part of the portfolio and taking advice though from like yourself, Byron, in terms of how to do that, because I think you need expertise, especially looking at things like HMOs and things like that now, because that's a whole new ball game, I think, than just renting a property out to a family or whatever. And I think definitely that is a trend that will always be there. Again, it's a fixed asset class that you will get cash flow from rental, but actually the physical value is going up as well. So it can be a win-win situation as part of your overall portfolio.
Yeah, and you're really right. And the property world changes as well. So we get trends like all of a sudden this last few years, you've got SA serviced accommodation, Airbnb,
Yeah,
Booking.com. These are all companies that actually don't own any of these
yeah,
properties. A bit
yeah,
like Uber, they don't own any taxis. But
yeah,
but they're still very successful because they provide a fantastic service. So
yeah.
yeah, how you can diversify your money through property is getting more and
Absolutely.
more diversified as time's going on, as people coming up with a lot more options for actually making money. So that brings me
Yeah,
on to another question then, Karen. Particularly between young people who have got limited income, and then you've
yeah,
got people at the other end of the scale who then have got money that they're worried it's inflation's killing their money,
yeah,
and that money's got to work to actually even break even and make money for them. So you've
yeah,
got two ends of the scale there. So let's start at the very beginning. If you're a young person, you've
mm,
said put 20% aside as much as
yeah,
you can. But is there a point, a certain amount of money they may build where they go, right, I've got this many thousands or hundreds, I really need to make that work. But is there a
yeah.
point where you go, right, £1,000, £2,000? At what point do you go, I need to now do something with this money? What would you say?
You see, I'd be doing something with that right from the start. I mean, I would say, invest in, I guess initially into something like a stocks and shares ISA. You can do that on a savings basis, if you like, from that point of view, whether it be £100. So if you earn if you've got £1,000 a month coming in from income, put £100 of that or £200 of that into a stocks and shares ISA, and then when that's built up. enough so that maybe you can get a deposit on a buy to let, then yes, you can then start saying, well, okay, out of this money now, I can start diversifying into other things. Because all I'm saying is that that money or that wealth provision for the future, yes, that can then go into property and what have you, but that's for your future. That's not for you to be dipping into now. That I think that's what I'm meaning. Yeah.
Yeah, that's cool. So the guys on the other end, they're the ones that have got money that are scared
Mm.
it's been eroded by time and inflation.
Yeah.
They really need to come and see people like yourself then.
Yeah, and you, I mean, I think, like I say, I will always talk to a client about, right, okay, let's have a look at what wealth they've got. Let's have a look at what their standard of living is, what income they need. Um, Obviously, if there's any debt, it's about what debt can we maybe get rid of or whatever. But it's looking at all of that, and property really can provide a great source of income as part of that. I mean, again, I look at so it, I'm very strategic when I plan with a client. I look at, as I say, I've already talked a little bit about the various asset classes and making sure there is a spread of assets, obviously in line with the client's risk. This is a very simplistic way of talking about strategic planning, but I look at timeframes as well. So I look at the short term, I look at the medium term, and I look at the long term. Um, and how much of your assets in theory should be in my view should be allocated for the long term, and how much should be allocated for the medium term, and how much you should be putting in your short term, the short term being the next 5 years really is what I'm talking about. So I think property absolutely should form um part of that. Um, if we're looking at between if we're looking at between say if we've got £1 million or whatever, then we might say, well, a couple of hundred of that we need for the liquidity in the short term, but the other, yeah, absolutely needs to be split fairly well, um, spread fairly well between the other asset classes that we've mentioned based on risk, and property a big part of it.
Okay, okay. We've only got a few minutes left, so what I want
Okay.
to do is just kind of stitch up a little bit. Two things. Uh,
Okay.
is there such a thing as good debt and bad debt?
Yes, I would say that there is, within reason. So good debt can be things like mortgages. So things that I guess are tied to a fixed asset in that way, that's managed well, and that reasonable interest rate. I think it's coming down to, if you are making more money on that debt than you are paying back, then it makes sense to keep that debt. I think it's when we're looking at things like credit cards, etc., where the APR can be horrendous on those kind of things. That's bad debt, because that's affecting your credit, and the money that you're coming in is just paying that back. So yes, there is very much a difference between good debt. Good debt is kind of enabling you to build your wealth,
Mm.
whereas bad debt is taking away your ability to build your wealth, I'd say.
That's very good. Yeah, that's very similar to the rich dad, poor dad. Is it an asset or is it a liability? If it's an
Absolutely. And
asset,
I've read those or listened to those. I like to listen to audio stuff. And yes, it makes full brilliant sense.
yeah.
Yeah.
I suppose for young people listening to this, that is a good idea. That there's so many podcasts now and information out there that's resources they can tap into and
Mm.
listen to in the car that can give them sound advice from people like
Yeah.
TiVo Hacker and people like and yourself, that really, if their education, will pay off massively, I suppose, wouldn't it?
I think so. But you know what? I guess because I know time's marching on, aren't they? But I think you know what? I know obviously I've got lots of qualifications and all that, and I read lots of different things, and I look at lots of different things. But ultimately, it's not. A lot of it is common sense, though. It is real common sense in terms of and that when you listen or read things like Rich Dad Poor Dad, it's common sense. It's about cash flow. I mean, that's their big thing, isn't it? Cash flow, making sure you need an asset that is generating an income, and if you've got that and that's coming in, you can go off and buy your Lamborghinis and what have you, because actually you've got this asset that that debt's always going to be,
Mm,
or that asset is going to be affordable from that asset that you've taken. It isn't it isn't rocket science. It's common sense, really. But and that's why these books and things like that are great to listen to. I think always you need to look at what is affordable. So it's working out how you can afford to, I guess, invest in your wealth strategies. Um, and it's your appetite for risk, which is why, again, ultimately, yes, it is common sense, but actually, by sitting down with an advisor, you can then work out actually how you can move forward based on your personal circumstances and your affordability, etc., appetite for risk. Because there is one size fits. There isn't one size fits all, is what I'm saying. Even though roughly the strategies can be very similar, but it's not one size fits all, and you've got to tailor any strategy to yourself, haven't you?
yeah. Okay, so that's been absolutely brilliant, Karen, what you've told us. Financial gold, really. So
Well, thank
we've
you.
got 4 minutes left. So I want to talk about your business. Okay.
Oh, okay, thank you.
I'm fascinated, right? That if I was a young guy and I just got quite a good job and I'm really happy I've got this good job. Let's say he's 21 years old and he's actually earning something like, let's say he's doing the 25K a year,
Yeah.
and he wants financial advice.
Yes.
Type of guy, if he knocked on your door and come to see Karen Sheldon, could he use your services even at that rate going forward? And could he really afford it? Or are you guys only for people that's got the £1 million plus? What is the range of when you come and see a Karen Sheldon? At what point?
Oh,
Is
I
it
do
worth
like
it?
that.
It's probably worth it from day one, to be honest, sounds of it. There's no
Yeah.
doubt about it. But I just wonder if you are useful for guys like that who want to start off really well in life, like my son.
Oh, no, definitely, definitely. I will absolutely talk to anyone. One of my goals is to make sure that everybody is financially independent. I don't think there's enough education. Um, so I'm happy to talk to anybody and guide anybody. So yeah, that there's no problem coming in to see me and having a conversation and looking at how we can set things up. And as I say to most anybody, the way we work anyway, our initial meeting, we don't charge for our initial meetings. The initial meeting is an exploration meeting. So we can sit down and we can ask questions, and we can have a conversation. And, quite often I guide a number of different people from there and say, right, okay, look, if you do this, this, and this, that'll get you to where you need to be in the short term. And I can then direct them to different websites or whatever to maybe even start the process themselves. So, more than happy to do that. So I don't think people should be put off by what our costs may or may not be, because the initial part of the process, there's no cost to it for the individual. And it might be from that conversation we work out that actually by talking to me at that point, it ends up being more than worthwhile anyway. So yeah.
That's really, Karen, and it's really good to hear that. That's
Yeah.
fantastic. So we've got 1 minute left. So I just want to use that minute to say thank you so much for spending this time with us. What you've said to be honest, we had a ruck of questions, but you're so good that you covered them most of the first half, first 15 minutes, which was great, which allowed me then to go a little bit rogue and ask you about, sort of like apps and so forth. So it's flowed really, really well. So we've really, really enjoyed your advice, Karen, and I will put this everywhere I can because it's been great. So thank you again for your time and talking to us. Really, really appreciate you taking the time.
No, thank you, Byron, for asking me. And just a little plug back to you in all of this as well, really. I think your expertise is vital as well as part of my repertoire, if you like. A lot of my clients need your advice from a property perspective. So, anybody wanting to talk about property and looking at investing in property needs to have you on board.